Treasury yields may be hitting record lows, but just the opposite is happening in the world of high yield. Since the start of the month, junk bonds have lost almost 4% in value. That's the biggest monthly decline since November 2008. So where do we go from here? Well, joining us now to give us his view is Ty Anderson, Global Head and Chief Investment Officer of High Yield Strategies at DB Advisors. Ty, welcome to Fast Forward after what has been a very, very tumultuous month, a couple weeks. High yield has gotten hit pretty hard here.
That's right.
But what separates what's happening now from 2008?
Well, we think the market is very, very different from 2008. 2008 was really a systemic shock. People are worried about banks being in business and the financial system. Today, it's a combination of two things, we think. There is a lot of noise coming out of contagion from the U.S. debt crisis, then sovereign debt crisis in the periphery of Europe, and also a lot of skepticism about the political system reacting to that well. So in those types of periods, there's a lot of volatility in markets, and credit risk markets like high yield trade in sympathy with equity markets most of the time. The thing that we take away from that is the real fundamental story is one of lower economic growth going forward, but that's where equities and high yield diverge very significantly. High yield does quite well in low but positive economic growth. Equities not so much. So if growth is low as we expect, high yield should diverge from equities and trade up to recognize that intrinsic value. But if we get the downside, we think a lot of that is already priced in.
Okay, so this sounds then, from your perspective, like it's a perfect time to get in and buy.
Well, there's no question that there's much more volatility and risk in the market from technical contagion, so this is not a risk-free market by any means. But we do think that the fundamental value is there, and for investors willing to accept that level of volatility, we think it's a good entry point. We don't think the intrinsic value of these bonds has fallen as much as the actual trading prices has fallen in the last 3 weeks.
Now, is that true for every sector? We've been taking a close look over the last couple of weeks at credit default swaps on banks, U.S. banks. Specifically, we heard Zara there talking about European banks, but U.S. banks, Bank of America is clearly having some problems. Stock price has been quite volatile, fallen below $7. But the CDS spreads have hit records week after week. Is that overdone?
Well, we think in general that the banks are in much better fundamental shape now than they were in 2008. There's been a lot of capital raising. Regulatory reform, while it's not in place yet, has set a different standard for banks. So banks, I think, fundamentally are better off. One market that's related to that, which is one that we think is actually getting to be relatively more interesting, is not the bank's credits, but credits the banks originate, the syndicated bank loan market, which is a cousin market to the high yield market. Those loans are senior and secured in the capital structure, whereas high yield bonds are subordinated.
And so these are issuers that would typically, or companies that could issue high yield bonds,
yes, exactly
actually
right.
Syndicate loans, offer debt through this bank loan process.
Right. So on a fundamental basis, if the economic condition gets worse, even in a recessionary environment, those loans on a fundamental basis should be more stable in value than the bonds because they're senior and secured. But they're not trading that way right now. Because of some technical noise in the market, particularly some retail outflows we've seen in the retail segment of that market, loans have traded down right on top of high yield in terms of the levels of declines in prices recently. And we think that could be it's getting to be a pretty interesting entry point for that specific asset class.
What type of yields are you looking at there?
Yields there, you could get 6% yield in a loan portfolio, maybe a little higher, 6.5%.
And what types of sectors are really utilizing that particular mechanism?
Well, it's a broad market sector-wise. It's
so you're
diversified
going to get
by sector.
retail companies, you'll get financial companies, you'll get auto companies.
Absolutely. We think today's market, with the increased volatility and risk and muted economic outlook, it's an interesting time to perhaps around the edges reposition a portfolio to some of the more stable sectors, sectors where revenues are more stable with changes in GDP, because you can get the same or higher yield for a safer credit than you could 3 weeks ago. So why not take both instead of just the risk-on trade?
And very quickly, would you stay focused here on the U.S., or are there bigger opportunities over in Europe, perhaps?
There are certainly opportunities in Europe. We run a global business. In general, the market is larger and more liquid here. And we still think some of the economic issues are a little more visible here than in Europe, but they're on an individual security selection basis, absolutely a number of good opportunities in Europe as well.
All right, Ty, we got to leave it there. Thank you so much for joining us here on Fast Forward. Interesting look into markets that are not quite so transparent, at least compared to equities. That was Ty Anderson, Global Head of High Yield Strategies at DB Advisors.